Heinz ketchup is indeed one of the most famous brands globally, sold in over 190 countries, and often considered the best ketchup in the world. However, Kraft Heinz isn't just about ketchup, it manufactures products across various segments, diversifying its portfolio. In each of these segments, it boasts powerful brands competing in the market. Let's delve into the financial indicators. It's noticeable that the company's revenue remains consistently at a certain level. However, when it comes to net profits, even the most seasoned expert might struggle to explain. It's evident that the company's assets significantly outweigh its liabilities. I rate the company at 4 out of 10. While it possesses dozens, if not hundreds, of brands generating revenue and billions of dollars in land, factories, and other existing assets, these assets don't come close to the $90 billion valuation. Looking at their financial statements, over $30 billion is goodwill, and another $40 billion is intangible assets. This is because the company actually owns a huge number of brands that it has previously acquired, often paying more than their actual value, hence the goodwill. Additionally, assets such as patents and production lines could indeed be worth billions. Currently, the company's market capitalization is $44 billion, but considering its assets, it's around $49 billion. One could argue that the company is undervalued and should be priced around 10% higher. In reality, the company has significant debt and, to manage it, buys and sells companies almost every year, often resulting in losses recorded as goodwill. Therefore, if all assets were to be sold, considering these losses from selling brands, a $45 billion price seems fair to me. I've already mentioned the company's dealings with its assets, making it difficult to determine its net profits. However, I believe the company has some potential. If I were the owner, I'd simply sell off weak brands, pay off debts, and then focus on expanding with the powerful brands. Since Heinz split off and took on a significant portion of the debt, it seems to be their development strategy. Despite being a giant already, the company still has room for growth. Looking at net profits, only now are they starting to look normal. However, one can observe that these revenues are at the level of 2016 when the company was priced at almost $90 per share. From this perspective, now is a great time to buy the company's shares. However, in my view, it's too complex a business. Each share in my portfolio gives me confidence and satisfaction, and after analyzing this stock, I see opportunities but also risks, which have now balanced out. If you're willing to take risks, this stock might be for you. If the company maintains its debt reduction strategy, shares could rise to $43 in the next 2 to 3 years. I won't be buying shares in this company. It has too many things I don't understand and significant debt that's nearly impossible to resolve while preserving all their brands. However, after interest rates are cut, the company might find it a bit easier. But I definitely don't want it in my portfolio. Subscribe to my channel to not miss future videos.